Let's go ahead and review the process underlying our tangency portfolio. The three most important words in investing are "I don't know." That's why we have a detailed, formulaic, repeatable process. We can't predict the future, so we base our decisions on the facts at hand. Let's start with the equity side of the portfolio. We use two pillars to help determine position size by country. The first is global GDP, and the second is global equity market cap. Both give an indication of size. We then adjust the market cap weightings based on valuation. We use both Shiller PE and market cap to GDP, and the data behind how good these are as predictors of future performance is very, very stunning. From a very high level, here's the Supernova Tangency equity portfolio versus the average Wall Street portfolio. For one more point of comparison, we look at the MSCI, FTSE, and S&P global equity indexes. We can see how they're weighted by countries versus global GDP, global market cap, and our tangency portfolio. What we can see is our tangency portfolio rhymes a lot more with the reality of the world. At a little bit more granular level, we can look at the tangency portfolio and the country-specific allocations. None of this is a guess. Every single thing we do here is based on a scientific process, and we have exact reasons why we want these exact percentages. We're not guessing with money. We have a process. Let's move on to the debt side of the portfolio. We use three pillars to help determine country position size: world GDP, world public debt outstanding, and world M2 money supply. When we're looking at public debt outstanding, we adjust those weightings to underweight heavily indebted countries and overweight underindebted countries. On the money supply side of the ledger, we overweight undervalued currencies and underweight overvalued currencies. Here's a snapshot of the tangency portfolio debt composition versus the debt portfolio of the average Wall Street portfolio. What we can see is that most investors are really over-allocating assets to U.S. bonds. This can really be detrimental to conservative investors if their home country goes through some sort of shock, just as Venezuela has last year, just as Russia did in 2014. This happens to countries periodically. You can reduce those odds via diversification. And then we can take a more granular look at the country-level debt exposure of our tangency portfolio. For every single country here, the weightings are determined by math, science, and a process. None of this is a guess. There are a few additional factors we like to think about. One of the most important is correlation. This pie chart is not the size of these investments in our portfolio, it's a visual representation of the low correlation of assets. Gold has an extremely low correlation to the rest of the asset classes, thus we want a larger than normal weight in gold. This is how you read that pie chart. The other thing we look at is global market size. That gives another indication for how large something should be. Of course, then we underweight or overweight based on valuation and correlation. At the end of the day, here's a pie chart of the asset class allocation of our tangency portfolio versus the average Wall Street portfolio. We believe ours does a much better job in terms of delivering diversification and focusing on a repeatable, dependable process. Here's our disclaimer and confidentiality. Feel free to reach out to us to discuss this in more detail.